Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out dakota.com to learn more about our services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am thrilled to welcome to the show today Matthew Wright, Chief Investment Officer and President of the Disciplina Group, an independent, employee-owned, outsourced chief investment officer firm. Matthew, welcome to Philadelphia. Welcome to the show.
Thank you, Robert. It's a pleasure to be here.
It's wonderful to have you here. We always appreciate guests coming into Philadelphia, particularly in the heart of summer. In July, most people are on vacation, but you're here in the studio with us, so thank you.
Thank you.
And Andrew O'Shea from Dakota, as always, thanks for being here.
Thanks. Glad to be here.
Nice to see you. How are your travels going?
So far, so good. A little slower this summer, which has been nice, but I'm sure it'll pick back up quite soon.
It usually does. It seems like just like kids go back to school earlier, the work ramps up a little earlier as well. So thanks for being here as well.
Of course.
Well, Matthew, we have a lot of questions to ask you. Before we do, I'm going to read your biography for the audience.
Sure.
Matthew Wright brings more than 30 years of leadership in institutional asset management. He is the founder of Disciplina Group, a firm dedicated to serving endowments and foundations through a disciplined, research-driven approach to portfolio construction and long-term capital strategy. Before launching Disciplina, Matthew served as Vice Chancellor for Investments and Chief Investment Officer at Vanderbilt University, where he oversaw the university's $3.7 billion endowment. His prior roles include senior investment roles at Emory University's Office of Investments, as well as senior positions at Bank of America Capital Management and Xerox. Matthew holds a BS in finance from Seton Hall University and an MBA from the University of Rochester. He is a respected voice in the investment community, currently serving on the investment committee at Aaron Wealth Advisors and as a member of Seton Hall's Board of Regents and Board of Trusts, where he is the former chair of the investment committee. Matthew, thank you so much for joining us here today. Congratulations on all your success. We look forward to talking about your journey.
You're most welcome. Thanks.
Well, let's start with Seton Hall. So you're in the classroom. Do you have any idea that this is the path that you were going to take?
Oh, no, not at all. I mean, I grew up actually in this area, in the Philadelphia area, and my primary focus in high school was, getting good grades. My parents were very, very diligent in terms of making sure we focused on our academics, but I was a high school baseball player as well. So my choice in looking at Seton Hall really was motivated by going to a decent school and playing baseball. Fortunately, I got a full tuition scholarship that was not baseball related, that was focused on academics, and I had an opportunity to, at the start, focus on being pre-med. That's what I thought I wanted to do. That's all I really knew. And, it's either doctor, lawyer, or teacher from my household and my upbringing. And then I quickly learned that from my coaches that was going to conflict between, what I truly wanted to do on the baseball side. So pivoted, and I met with my father on I think it was on the winter break or Thanksgiving break, and said, I'm going to have to switch my major to have a little bit more balance in my academic life and my athletic life. And we came away with coming up with finance. It was very, very serendipitous. I mean, we went through in those times kind of a bulletin that said, what's your major? And, he looked at accounting. He says, no, you don't look like an accounting person. You definitely aren't a marketing person. You're not that outgoing. There's just something called finance, which is kind of a blend between accounting and economics. And I think you should look at that.
What are some of those lessons from baseball that you still think about today?
Sure. I think one of the things from baseball really that drove me into the investment field is that every day there's a score. Every day there's an at-bat or a batter or something. Just being very, very results-oriented. There's not this sense of, did I do a good job or did I not do a good job? You get immediate feedback. So I really enjoy that. The other big takeaway about baseball, which a lot of people don't appreciate that don't know the game, it's a very anticipatory game. There seems as though there's nothing actually going on, but if players are good, particularly if they're in the field, they're going through several different iterations of what happens if the ball goes here, if it goes there, if it goes up in the air, on the ground, left, right, what have you, where are the base runners? And it's very, very similar to investments, whereby you have a strategy that you're working with, and then you have to go through these kind of mental iterations of what if, and then being in a position to see how you'll respond to it or how your portfolio will respond to it, and hopefully it'll respond favorably in both instances.
Interesting. Thank you for sharing that. What was the transition like leaving the game? I'm always curious about somebody who played Division I athletics successfully. I know you went on an education scholarship, and that's excellent to hear. But when you think about that departure, having to start something up new for the first time, what was that process like for you?
It's really hard. It's really hard. If you think about it, you're finishing up and you're like 20, 21 years old. I started playing baseball on the school grounds around 7 years old. So, over 2/3 of my life, I had spent time doing this and preparing for this. So it's a very, very difficult transition. So you try to pick up other things. I got heavily into fitness. I started to adopt tennis as a passion and a love. And then I finally, at a certain age, a good friend of mine told me that they have adult baseball leagues for people that are no longer playing, either try to get to the pros or what have you. And at the age of 30, I started to play the game again.
Oh, that's great.
And the neat thing about it is that I think I enjoy the game more now because I'm doing it for the love of the game, and I have a better appreciation of the game than when I was younger.
Do you still have that competitive drive?
Absolutely.
What was your position?
I was a center fielder.
Oh, wonderful. Thank you for sharing all that.
Yeah.
So now you're leaving school, you're starting your career up. What were those first jobs like for you? How did you think about the path ultimately into asset management and manager selection?
In the summer of my junior year, I had an internship actually with a wealth manager with a firm called Drexel Burnham Lambert. Then eventually he went over to a French firm called Prudential Bache, which became Prudential. And through that experience, I got a great passion for the investment industry. And at the end of that summer, I came away with the realization that I wanted to become a portfolio manager. So here I am at the age of 20 years old. And I said, okay, this is what I want to do. And then I looked around at the opportunities that were being presented by the Career Services Department at Seton Hall and the types of positions. And I felt the best path would be to go directly to graduate school to get my MBA. So I went to the University of Rochester straight out of undergrad with limited experience and learned a lot of financial theory, investment theory, and it was a great experience. But unfortunately, at the timing of my graduation, we were in the midst of a war. This is 1991. And I did a pivot. I went to corporate America. I was engaged. I needed a job. I had student loans. There's stuff I had to take care of. But I went to work for Xerox Corporation, having interned there the prior summer. And fortunately, I just kept an open mind. I was just pretty dogmatic about the fact that if I want to do investments, I have to find a way. And Xerox had a large pension, and they had an investment office. And I just really positioned myself through networking and contacts to get into that office. And fortunately, a position became available, and I got to work for a wonderful woman by the name of Myra Drucker.
To our audience under 30 years old, Xerox was a printing company. I have to remind some of my students when I talk about these companies obviously still existing, but at the time, that was a very big job. So congratulations on getting it. And I can imagine having thought about this career in sports for so long and now getting into finance, getting your MBA and then into Xerox. It sounds like too, having the right mentor was very important.
Oh, absolutely. Absolutely. And it was very interesting. Another mentor of mine, Mary Cahill, who actually worked in the investment office. Shortly after getting to Xerox, I think I got there, I was around 25, 26 years old. And she told me about the CFA program. And at that time, there was limited visibility on the CFA program. She had more confidence in me than myself. She said, "You're smart, you can do this. Here's what the program is. This is how much studying is involved." And she said, "I want you to think about it." And literally, she kind of gave me a week or two to think about it. And we went forward and I got into the program. And it was a great opportunity very early on to pair, again, more of an academic, theoretical with the practical of actually working in the investment profession. So over a 3-year period, I paralleled working at Xerox with getting my CFA, and then that dovetailed into my experience at Bank of America on the portfolio management side, and then ultimately migrating over to the nonprofit side, working at Emory and Vanderbilt University.
So what was that transition like into Emory University? So you're in an endowment for the first time, working with tax-exempt pools of capital. How did you take that job kind of as a challenge, and what were you looking to accomplish, and what were your roles and responsibilities initially?
It was a great opportunity in that I got to an inflection point in life where, and I think it is a function of just my upbringing and some personal experiences where, and you probably teach this at school, if you are actually working for the company, what you're trying to do is drive the value of the stock price. That's the goal and the objective. And, around right before turning 30, I kind of felt a little lost in that, I wanted to do something that had a little bit more impact and could see tangible results, maybe from a social aspect. So I was actually recruited by Mary. She had left Xerox, went to Emory University, and was setting up an investment office. And she recruited me, and I joined her. So I came in as her number 2, the director of investments. And while I was there, my responsibility was for overseeing the general asset allocation, putting that together, helping build out the team, and then sourcing investments, both on the traditional and the alternative side, to implement within the portfolio. There was also a unique single stock position scenario at Emory University, which afforded us a lot of opportunity for me to parlay my experience as a portfolio manager at Bank of America in the kind of more traditional allocator role. So it was a wonderful experience, great opportunity, and we built out a great team, and a number of those individuals have gone on to do great things throughout the industry.
Yeah, Emory is a very well-known starting ground and stomping ground for a lot of very successful institutional allocators. So a great place to start out. But you went to Vanderbilt. So what was that transition like as you think about sitting in the office in Georgia? You are, I would assume, doing pretty well. Mm-hmm. Did the call come in directly from Vanderbilt, or were you thinking about something different?
I was actually thinking about something different. So if we go back to the time period, we're looking at 2006. I had been working with Mary for about 5 years, obviously a continuation from the Xerox experience, working with her there. And I was literally thinking about an opportunity of doing an OCIO firm, quite frankly. The impetus behind that really stemmed from doing a lot of industry-related events in Atlanta, whereby I got to know some of the other smaller institutions. And many of them would come to us and say, hey, we need your help. And I was like, yeah, we can give you manager ideas, this or that. And then they literally said, no, we need your help in terms of implementing our portfolios and policy and governance and things of that nature. And I looked at myself and I said, well, I got a full-time job. I can't do that. And then it dawned on me that, there was a need for smaller institutions to have a team that had the capabilities of a $1 billion plus organization to implement their portfolios, to move their missions forward. I had spent time with some close advisors and friends. I was putting together a business plan. I came up with the name of the firm. It was very, very narrow in scope in terms of the people that I was sharing this with. Obviously, I had shared this with my wife and maybe 1 or 2 other individuals. And then Vanderbilt called. And the unique thing about it was there was a recruiter that actually called. And I had known the recruiter. And the recruiter called and said, hey, I got a wonderful position for you. We've been speaking before. And what do you think? And I said, no. So, because I was really focused on this business plan. So then they called a second time. And I said, no. And I was like, and they were like, well, wait a second. Okay. You told us that you were interested in an opportunity where you could work at a $1 billion plus institution, preferably within the Southeast, and that you would have discretion in terms of implementing the decisions on the investment portfolio. So this is that opportunity. Why do you not want to pursue it? Don't answer that question. I understand you have to travel. You're going to be gone for a week, but I'm going to call you back when you get back. And if you say no, I'll understand. But if you don't say no, then we'll move forward in this process. So I've reflected on that. I went to some of my closest friends in terms of those that I was working on in terms of putting this business plan together. I went to my wife and I reflected, and they said, that business plan sounds good, but there are not too many opportunities to become the chief investment officer for a multi-billion-dollar plan, particularly in the Southeast, an area that you want to live. And you should probably put that on the table and pursue it. So I did, and they did a national search, and I got the position, and it was a wonderful experience. We migrated my family from Atlanta to Nashville. We implemented a number of different changes, risk systems, controls. We put together a wonderful team, and then the financial crisis occurred, and we were actually. It was very, very providential in that a number of the things that we actually instilled prepared us to navigate the financial crisis very, very well, whereas Vanderbilt ended up being one of the top performers during the global financial crisis because we had instilled those controls and risk parameters and things of that nature and took on a new way of looking at the portfolio.
That's wonderful. Thank you for sharing that story.
Prior to you joining, was there an internal team or had they outsourced the endowment prior to you joining?
There was an internal team there. So Vanderbilt was of the size, coming out of Emory, I think we were around $6 billion. Vanderbilt was about $4 billion, and they had a team. But in those times when individuals switched over, you're going in, you're inheriting a team. There are some people that are moving out. There's some people that are staying. So you're going through a transition process of really, other than, finding out where, the men's room is, there are a lot of things that you have to uncover and figure out. So we went from, I think they had a very, very small, narrow team of about 7 individuals. That went down to about 5, and then we expanded. And by the time I left in 2013, we had about 20 people working on the team.
Wow.
But you never shook that entrepreneurial bug.
No.
So where did you hang the Post-it note to remind you to start that business in the offices?
Actually, it was actually held in my wife's head. It was a very, very interesting story. We were very blessed having the experience at Vanderbilt. Our kids were doing very, very well. And, I came home, I recall it was in 2010. I can't really remember specifically. And our routine was, obviously I'd come home and have dinner with the family. And we're sitting there having dinner. And my wife says, do you want to start that business that you were talking about? And I'm looking at her and I'm like, we just went through the global financial crisis. We survived that. The family's doing well. We're in a very fortunate situation where we're having wonderful vacations for spring break and summer break. And why would we want to take a step back in that regard? And, I expressed that to her and she said, yes, but I know you. And if you don't take on this opportunity to do this, I know that you'll regret it later. So I took that to heart, and we had a family meeting of the minds in terms of if we were going to do this, we had to be very, very good stewards of what we had because we didn't know how long it would take effect and how much dollars we'd have to put towards it. And we launched in 2013, first quarter of 2013.
That's wonderful. What did you want it to be when you first set out to start the business? And for our audience who are less familiar with Disciplina, what is it today?
I think it is what I wanted it to be. I think, it is really a culmination of not only my professional experiences, but a number of personal experiences. I wanted us to be in a situation whereby we would be an organization that could work with mission-based nonprofits that are making an impact in society. I would argue, several of the billion-dollar-plus institutions are wonderful institutions and support a number of different efforts. But, if I think about my background in terms of being, fortunate enough to get a full tuition scholarship, and at the time, if I hadn't gotten that scholarship, I wouldn't be able to go to college straight out of high school. If I think about my brother who had cerebral palsy in terms of some of the challenges that he had and some of the support that he got in terms of various different areas, whether it be camps or medical or physical. If I think about my parents in terms of their focus on education and, social and societal issues, it really afforded us an opportunity to afford our clients currently that we have today, and quite frankly, a mission field of institutions to punch above their weight and deliver through great stewardship and giving them access and asset allocations that can create perpetual change.
And as you thought about building out this team, what does the team look like today? How do you think about roles and responsibilities, and how do you generate that success for those clients?
Interestingly enough, so I had a business plan, and obviously that was archived from 2006 to 2012. But I was fortunate in terms of having 2 founding partners. One, Elena Kaprevich, who I worked with at Emory University. and Vanderbilt. I recruited her to work at Vanderbilt, and then Brant Smith as well worked with me at Emory University. I recruited him to go to Vanderbilt. They are two of my founding partners, and the three of us collectively, really are kind of the ethos and have that continuity, I would say, from the Emory Vanderbilt experience in terms of not only culture, but implementation of our investment portfolios. We are supported by a strong team that we've built out. Brian Arsenault, who has a credit background, he's our credit strategist. He gives us great insights, having worked at the likes of JP Morgan and Morgan Stanley, as we look at credit throughout our entire portfolio and think about markets and valuations. Duke Williams, who's been an allocator across the pension, insurance, and endowments and foundations. He worked at LSU Foundation. I've known him for a number of years. So that's really the core of our investment team. And what we've done and what we've learned to do is really have every individual is a generalist to a certain degree. And we have a very, very collaborative approach versus a silo approach. So we can actually source, debate, diligence opportunities and put them forward in our portfolio in a high convection context versus being more of a siloed model. Each organization that I've worked with, dating back to Xerox, has always had a generalist type approach. And I think sometimes our industry does a bit of a disservice by siloing things so much. Like I say, and if you go back to the global financial crisis, you could have the best equity portfolio, the best fixed income portfolio, the best alternatives portfolio, but if they're not integrated, it's not going to work. So we really, really think about that integration and that collaboration. And then that collaboration also, quite frankly, creates a beautiful succession plan. So to the extent that if someone is on leave or vacation or what have you, or unfortunately someone departs, there still is a cohesive nature and an understanding of everything that we're doing across the portfolio from a portfolio management standpoint, manager selection standpoint, client standpoint, and then risk management standpoint.
You've spent most of your career and I was maybe even starting with sports, being recruited, meaning there's people who are coming after you. Your colleagues want you to do this. You are being recruited by Vanderbilt. A lot of inbound. Now you're starting a business and everything is outbound. You have to make the calls. You've got to build the business. What was that process like for you? Did you find that you had to make a switch in your mind? I say this from the perspective of, for example, a consultant or an allocator who goes to the asset management side. They've received calls their whole career. Now, all of a sudden, they have to make calls and they have to build their own business or they have to build their own book. What was that process like for you?
It was hard. It was hard. It's not something that I ever done. And I think my dad was very clairvoyant and said, you're not a marketing type. And for all the marketing professionals, I'll acknowledge that. But it's necessary to grow your business, to build your brand, and to actually make the impact that we strive to make an impact to. So, at first, I did what I observed from everyone else. We called certain people. We went to our network. We took the pitch book, things of that nature. And there was a really false expectation that, pardon the term, the sales cycle would be fairly quick. And it's not. So then I took a step back and I think we really reflected on, it's really about, and we're fortunate and we're blessed that we have the runway and the bandwidth to do this. It's really about building relationships. So let's put the pitch book aside. Let's have a conversation. Let's identify organizations, understand what their needs are, listen very, very well, express who we are, and then just continually follow up. And to the extent that the opportunity truly does come to actually, bring on a client, that's where it becomes more formalized. I think what I never really recognized as I was being recruited or I was being pitched, that's how the process truly works. And that's a genuine process, to the extent, like everyone else, if someone calls you or comes up with you or on the street and they come to you and they push something in your face, you don't want it. You really have to create, a relationship. And I think, I'm very, very thankful that we've been able to do that with the clients that we have. And I'm, looking forward to the opportunity to expand that in a controlled manner. And I think it's also good in that it kind of speaks to the type of relationships that we have. We have not lost a client since the firm's been started. We've been up and running for 13 years, and we have very, very deep relationships with our clients. And that's probably one of the most gratifying things about what we're doing. Not only, professionally and the intellectual stimulation and working with a great team, but fostering deep relationships and moving the needle on the mission of these clients.
What does the asset manager look like in terms of the type of managers that Disciplina will typically look for their clients in terms of asset size, profile, asset class, just to set the stage in terms of once you start to actually dig in?
We have discretion to allocate across our entire client portfolios. We have a philosophical view that markets are fairly efficient in the large asset classes. So let me take a step back. So large cap U.S. equities, think of S&P 500, core fixed income, think of that nature. So we are very, very commoditized, quite frankly, in terms of indexing in those areas. So there's not a big distinction between, large block company A or B as it relates to that portion of the portfolio. Now, in the other areas of the portfolio that we feel are less efficient, think about emerging markets, think about hedge funds, think about private markets as well, even natural resources and the like. We've really honed in on a philosophy that we have carried over, quite frankly, since our Emory days of focusing on boutique, niche, typically employee-owned organizations. They could have a single star, or they could have a process that is very, very collaborative and a core team to implement that strategy. But we have found those relationships and diligencing those firms have moved the needle more in terms of generating excess return, and it generated more continuity in terms of relationships versus, larger firms whereby we have one representative 1 year and then 2 years later somebody else is there, and you kind of lose touch with, the people and the qualitative elements that we really hone in on to figure out if there's going to be a persistence of returns and value add in terms of relationship.
I'd just be curious about the structure. I've seen some OCIOs have pooled vehicles that they put clients in. Some do it, each client, you're managing that account directly, but using maybe a lot of the same managers. How have you set it up structurally to invest on behalf of your clients?
No, that's a great question. So out the gate, we thought about pooled vehicles because that's what everybody else was doing. And then we came away with, we have no clients, we have no assets. Clients are interested in this pooled vehicle from this guy from Nashville. So let's create a little bit more flexibility and let's give them separately managed accounts. So effectively, we are implementing the same way we implemented at Vanderbilt and Emory, where the client has a third-party custodian. We are getting the asset allocation approved by them, and then we are procuring various different investment managers to put in their portfolio. So it's uniquely a separately managed account. Every investment is in the client's name, but we have discretion in terms of rebalancing, positioning, hiring and firing, monitoring, and the like. We have found, particularly for the market that we're focusing on, which is typically that $100 to $500 million market, that provides them a great service and a lot of flexibility. It gives them a sense of comfort that they're not being forced into a structure. Mm-hmm. It's giving them more flexibility and transparency in terms of how we're implementing their portfolios.
Mm-hmm. Are you thinking about it in a traditional endowment model where illiquid assets are generally in 30 to 40%? What's the tolerance for illiquidity for your clients, just given their size? And
for our clients, given their size, some of them have yet to have private markets in their portfolios. So some have zero. But by and large, most of our clients on the private market side, we're moving them to kind of the 20% level as it relates to private markets. We feel as though that is a nice complement to their global equity portion of their portfolio to drive the growth of the returns. And then we have hedge funds within their portfolios, but we really focus on hedge funds that typically have liquidity within a year. And that's more of a philosophical view. So specifically to your question, in terms of illiquid assets, typically it's around 20, 25%. However, there are clients where we inherit a number of legacy assets. Mm-hmm. So collectively they could be higher, but we want to bring them down to that kind of targeted level.
Feel free to talk in between hedge funds and private markets. But when you think about your manager underwriting process, starting with sourcing, if you wouldn't mind kind of taking us through what that process looks like, just in terms of how you think about it structurally.
starting off at a very, very high level, we have our asset allocation, and each asset class has a particular role within the portfolio. We have private markets and we have global equities as kind of the growth engines that drive the perpetual growth of the entity. Then we have diversifiers, which is a combination of absolute return hedge funds and then fixed income. And then we have inflation protection, which tends to incorporate diversified commodities and real estate. We tend to migrate more so on the liquid side of real estate than the illiquid side of real estate. In so doing that, we've been doing this for over 25 years. So we have a broad network of firms that we have worked with previously. There are a number of people that have switched chairs at various different firms as well. So they are always on our radar and they always keep us in touch. So thinking about it in terms of just general sourcing, the professionals on our team are known commodities. They have networks and relationships. There are placement agents. There are marketers. We tend not to go to a database to source things. We actually create our own proprietary database where we actually compile managers and we actually monitor them. Each day, we get tens of 10 to 25 probably emails and solicitations of various different firms. And it's a lot, but we take our time to actually go through and figure out if it's something that we want to follow up on. The general model that we'll focus on are boutique niche firms with a unique and proprietary edge. That sounds very, very simplistic, but we know what we have in our portfolio and we're looking for something to complement that, not necessarily replace it. We typically have pretty long-standing relationships with our managers. So in a given year, there's not a high degree of turnover. If there is a high degree of turnover, we're not doing our jobs right.
How do you define edge? Because edge is something that we talk about a lot. We hear all the time. In your experience, which is extensive, when you're listening to a manager that you don't know as well, so somebody you've decided to bring into the office, it's the first time you're meeting with them, what do you want to hear in the way that they describe their competitive edge?
Yeah, we focus on obviously the personnel and the people, but if they can translate their personnel, people, and experiences in terms of doing something that is unique and differentiated, that's something that we will gravitate towards. Again, if we go back to philosophically thinking about markets are efficient in certain areas, once we start to migrate over into alternative space in some of these other areas, it's kind of easier to identify things that are differentiated in nature. For instance, if there is a strategy whereby they're looking at a narrow universe, a large universe of securities, but there's a narrow subset. And because of whether it be rating agency rules or whether it be certain market dynamics, there's a certain omission or that space is not looked over, and that's where they traverse. Very, very excited about a conversation about that, because that means that we're, as I've said to my team, and they've heard it several times, we can see the 6-foot kid in the Pee Wee basketball league. Hopefully that kid has some skill, but even if the kid does not have skill, there's something that stands out, versus the group that he's playing with or she's playing with that gives them an edge to execute and add value and be differentiated. So that's what we're always striving for.
That's great. It makes a lot of sense. So how about the process itself? So now the manager's in-house, you've identified the edge, you know that there's a need. How do you map out that process? Everything from how long it typically takes to the types of qualitative and quantitative attributes that you're looking to uncover.
Sure. So it depends on the strategy. So to the extent that it's a simplistic strategy, that process can run a little bit quicker, and if there is a need for the portfolio. But typically, as we're getting these contacts or these introductions, it's just like anything else. There's a bit of a sifting process. Okay, that looks interesting. That doesn't. That looks interesting. And the two that look interesting, then you reach out to those firms and say, hey, can you send me your profile on a regular basis? And you start to theorize what your expectations are of their performance, particularly in certain market environments. So if you have a market environment that's going up or that's steady, it's kind of, okay. But to the extent there's a broad pullback or there's a broad rush up, and then you get that report and it actually validates what your initial assumptions were in terms of their ability to navigate the downside, Okay, that prompts, a further, investigation. And once we actually do that, we meet as a team, we elevate, and we meet as a committee, and we say, we would like to take this forward for due diligence because we think there is something differentiated, is distinguishable, and there's some value that can be added by this firm. The due diligence actually encompasses a number of different things. Initially, and people have heard this, there's 4 Ps. There's, personnel, philosophy, process, and then there's performance. A lot of people focus on the performance first. We kind of do that on the back end. So once we've gotten to the point where we're actually diligencing, we're actually looking at the people, the depth of the people, the continuity of the people, alignment of interests, are the appropriate incentives involved? The philosophy, is a philosophy that can have some permeance and has been rigored and tested? And then the process of trying to do that in a repeatable manner to execute. Then, if that's satisfactory, then we will go forward to kind of look at the operational elements and how they've actually put the firm together, what the ownership structure is, and so on and so forth. And then finally, if we're favorable on all of those different elements, we'll look for the performance to validate the qualitative.
Where does the C sit, the conviction? When you're thinking about the conviction in a manager, it could also be concentration. I think conviction is a nicer way to talk about how much are you going to put into that one idea. So when you think about conviction in your portfolio, your manager's portfolio, what's most important? How much conviction do you want to see? How much concentration do you want to see?
I won't put a number on it, but I think, one of the things that I've learned from the industry is that there are competing needs and interest. If we do have, let's take a step back, a high conviction in our team and its ability to diligence an opportunity, then we should have an equal level of conviction in terms of implementing that in our client portfolio. If we do not, then we shouldn't put it in the portfolio. We don't want to be in a situation where we have a proliferation of names and supposedly we have a good process of picking managers, but we don't size them whereby that value added can actually flow through to the returns of the client. One of the things that I was very, very mindful of in terms of inheriting portfolios and seeing that is that oftentimes institutional portfolios have too many managers. Mm-hmm. You can't manage all the relationships. You can't get to the depth of what's driving the value and be proactive in terms of making a change, in terms of adding more capital or taking more capital away. So you have to take a step back and you have to create a portfolio that is concentrated in nature based upon that conviction level, but it also gives you an opportunity to make pretty much a binary decision. You either keep it or you don't. There's no middle road. And I think our industry has gotten kind of caught in this trap of, a lot of people don't have conviction, so we'll just have a lot of great managers, and at the end of the day, the fees drag down the portfolio, the cycles of the performance don't work, and you get suboptimal results. So we've taken a step back and say, okay, if we truly believe what we're doing is good, we should implement that with conviction to our client portfolios as well.
You strike me as someone who's a connoisseur of words. So when you think about the word opportunistic, if you're a hedge fund manager, we opportunistically short. We opportunistically go into privates. So how do you feel about a manager who thinks opportunistically? When you're hiring them for a very specific mandate, because you have a very specific asset allocation model, but they want to take opportunities to go into other areas that might drive value for their portfolio. So how do you feel about those managers that may short, that may go into privates, like the hedge fund model? What are your thoughts there?
We're not big fans of it. Everything that we do has a portfolio management and risk management framework. So one of the challenges is that if a manager has, and I'm not saying that we don't give our managers discretion and leeway, but if they have discretion and leeway outside of the scope of the mandate, when we actually put that portfolio together, contextually, we kind of lose sight of what the true exposures are and our ability to actually manage and hedge some of those exposures. So what we strive to do is find experts in a certain area, have an understanding of the areas that they traverse in and what they do, and then we limit having opportunistic. Good, bad, or indifferent. One instance is global macro. I am not going to profess that our firm or we are global macro players and we're great timers of the market. However, if we've been entrusted to manage portfolios on behalf of our clients, I think, especially with an asset allocation and a strategy, we need to be very, very mindful of what's in that portfolio. If we outsource that effectively to someone that is moving the portfolio around opportunistically, when things go awry, we're going to probably perform different than expectations. And that's not a good outcome for the client. So we actually pull back from those areas where people are broadly opportunistic and then make things kind of narrow in nature.
Anything in the portfolio today that you likely wouldn't see in one of your competitors' portfolios?
You know, the industry has grown so much, so we're always looking on the margin for things that are differentiated. But, you know, there's some options-related strategies that we're looking at. There are reinsurance. That's something that we've looked at and we've incorporated within our client portfolios. You know, there's some kind of the traditional private equity and venture strategies, but I think we have a very, very strong portfolio and high conviction in a number of managers that are doing great things and creating great companies and have created great companies. There's not a lot of benign mainstream stuff. You know, I think a lot of things are to a certain degree against consensus, and that's really, again, taking the totality of the portfolio and looking for that portfolio to add value versus its target versus more of a silo type approach.
I teach venture capital, so I can't help myself. I always want to learn a little bit about what you're doing. How early stage will you look at VC?
We have multi-stage venture funds, you know, so we have, you know, some that are just idea driven. You know, there's not even a company yet. And then the venture capitalists will work with the idea generator to create a company around that. We have, you know, early stage, we have growth equity. We have multi-stage firms that we're venture managers that we're working with to implement these ideas. And we've been fortunate of being in the space for a number of years. Just as I talked about, you know, how we built our business and brought on clients, we went through a very, very deliberate courtship process, even when firms were not open to additional capital, of building those relationships, informing them of who we are, you know, attending their AGMs, and then getting to the place where we've been able to allocate to a pretty stout list of firms that, you know, people would be quite enviable of. And again, small startup, something that you've never heard of, no concept idea, all the way to some of the greatest companies that you're seeing on the private side that are getting additional fundings and increasing valuations in the billions of dollars.
How about your views on some of the endowment peers, the larger endowment peers that have been selling out of their private equity books, so reducing their exposure? Thoughts on any risks that are inherent in private equity today that you're cognizant of, talking to your clients about?
Well, I think the biggest risk in private equity as a whole is just the absence of distributions back. You know, we've been fortunate where we have been getting some distributions back on our side. If you look at these larger institutions, I think there had been a shift to allocating to private markets because it effectively would provide enhanced returns. But if you don't look at the liquidity profile of your institution, you know, you have to balance, you know, what are their spending needs, how much operational support does that provide in a given year, and then what are the capital call requirements and the such as it relates to the private assets. So, you know, it's not an infinite capacity to allocate to the space. And I think, you know, some institutions have gotten to a place whereby they have to prize the liquidity, you know, meaning selling and getting capital in over the potential return from these allocations. And I think that also stems from a conversation we had previously about conviction. You know, if you're not conviction weighting things, you can get into a situation where you have a proliferation in your portfolio of names and exposure and allocation above and beyond what you otherwise wanted. Because you didn't take the discipline of saying, okay, I got to make a tough decision. It's either A or B. I can't do A and B.
Mm-hmm. Private credit. How do you think about private credit? How is it allocated in the portfolio? One way to ask it is, how do you define it? How do you define it, and then how do you allocate to it?
In terms of private credit, so historically within the marketplace, banks have played a role in terms of extending credit to corporations for whatever their needs are, typically strongly collateralized in nature, very, very conservative underwriting. And with the global financial crisis and the capital requirements of banks, that opportunity, whether it be directly in terms of a direct lending component, or whether it be proprietary capital from an institution, has not been available. So here we have funds and firms that are raising capital, and they're operating effectively like a bank. So they are sourcing opportunities, they're underwriting deals, and they're extending that credit. So they are performing, an intermediary function whereby banks, whether they be investment banking firms or traditional commercial banks, have performed that function. So that's where that actually plays out. As it relates to our client portfolios, we actually have a very, very high threshold in terms of the return target for tying up any liquidity beyond a year. And, whether we'll be able to get it or not, but we're typically underwriting at 20% or more. So what that does then is it forces us to not really consider private credit, because typically you're underwriting that in somewhere between kind of the 12 to 15%, maybe your liquidity profile somewhere between 3 and 7 years versus 10 years. But we really use, if we're going to go illiquid, like they say, if you're going to go, you're going to go big or don't go at all. So if we're going to take on illiquidity, we're looking for outsized returns. So we really don't incorporate it. There's a rare exception whereby we have clients, back to your initial question, whereby clients have no private markets in their portfolio. We will incorporate it to get the program going. And what that effectively does is it eliminates something called the J curve. Basically, when you invest in private markets, you're putting capital in, and then you don't see the valuations, and there's a degradation of returns, and then there's a pop. And from an educational standpoint, we want to educate our clients that private markets are a good thing. So we may complement that private markets with private credit to mitigate that J curve, so we don't get to a situation where we're 3 or 5 years in and the client observes it as a negative and wants to abandon the strategy. And what we're saying is we're trying to be supportive of the client and educate them to try to mitigate that J curve by incorporating things like private credit in those rare instances. But typically, our clients have private market allocations in place, and we typically don't look at private credit on a go-forward basis.
How about current search activity? Anything on the horizon?
We're always looking at ideas. We're always meeting with managers. We continue to try to evaluate the next generation, particularly on the venture side, because the most successful venture funds tend to be capacity constrained. And we're always looking for differentiated returns on the absolute return side, and then in less efficient markets like emerging markets. So we're always looking at opportunities in those spaces, but I wouldn't say we have any active searches in place. We're just sourcing and doing our job. And again, to the extent that we get the affirmation from monitoring these managers, we will elevate as the opportunities present themselves within our client portfolios.
When you think about emerging markets, when you have teams that are larger in scale and capacity and can be on the ground in some of these less covered, inefficient markets versus the highly concentrated team, maybe based in London or New York or here in Philadelphia, any thoughts about, preferences for you as it relates to size of team when it comes to emerging markets?
Philosophically, we have had a bias to those with more local play. That local can be one of two things. They can have direct people on the ground in various different markets, or they could be centralized in nature, travel, but even though they travel, the members of their team have a certain affinity, connection. Maybe they were educated, born and raised, broad networks within those markets. We think by taking that type of approach, we tend to get exposure for our client portfolios to emerging market companies that are more localized in nature. All things being equal, I think Samsung is a great, wonderful company, but in terms of diversifying out our portfolio, I think we would look for a more localized Korean company to be within our client portfolios versus, a global conglomerate. And again, our game is terms of, finding differentiated returns, diversification, and by having more of a localized approach, I think we can garner that.
Speaking to the hedge fund portfolio, hedge funds mean a lot of different things to different people. You referenced it as absolute return, which to me would indicate potentially more of a return profile that's less correlated, more defensive, Could you just speak to that, how you think about hedge funds and the sub-styles of hedge funds?
No, absolutely. I think you're absolutely right. That's how we do it. We really view it as a diversifier to augment our fixed income allocation that provides a balance for the portfolio to the extent that we have a global economic shock that pushes down equity values. We want to have something in our portfolio that can help ride out the storm. So we tend to focus on credit arbitrage strategies. We will look at multi-strategy, event-driven funds. We will look at opportunistic, but we call opportunistic as something that can't be defined in a particular category. So not necessarily something like global macro, but I talked about reinsurance. I talked about volatility arbitrage and option-related strategies. We have historically looked at things like equity long short, and we have incorporated that in the portfolio. But I think there's a high barrier to entry for us to look at that, because at the end of the day, one of the things that we learned, if we go back many years, whether it be 2001, .com era, if we go through the 2000s, the global financial crisis, people have allocated to so many different areas where they think they're getting diversification, but to the extent that the market pulls back, they don't have it. Yep. So we're very, very maniacal that if we're adding to this space, we truly want it to be a diversifier.
Yep. Very helpful. And then emerging managers, you mentioned boutique specialists. Will you allocate earlier in their life cycle, or do you generally you want to see some time in larger asset base?
We will actually do that. That's really something that evolved from our days at Emory. It's something that I had never really thought about before I got into the endowment and foundation space. But, and again, I can't speak for all organizations, but one of the unique things about that industry is that, you have the mission and goal of your institution. But typically, the boards and the governance structure incorporate a compensation system whereby they compare you to other institutions. Mm-hmm. So to the extent that you want to differentiate and stand apart, you have to be early in these areas, and you have to have conviction in terms of putting it into your portfolio. So not saying, again, someone has zero assets and we'll give them a ton of money, but to the extent they are new and, quite frankly, we're looking for not new investors. We're looking for seasoned investors that are offering a new firm or a new product or a new fund. There's a difference there. And in so doing, if we can underwrite what they've done previously and put the diligence framework together and then get conviction, then we will allocate to newer firms or newer funds. I think one of the things that have been most rewarding to us is that we've allocated to firms maybe early on in their history, and we have partnered with them in terms of how we've grown and how they've grown. And then all of a sudden, others are striving to come in. And the most refreshing thing is that the manager says, we're close to new assets. Yep. So you're on the inside with the manager looking out, and there are other people that want to get in. So that's really, truly rewarding. And it gives us the feeling that we've done our job the right way. So, I think the industry tend to focus a lot on performance and, heuristic things like, okay, number of years in business, 10-year track record, so on and so forth. And if you truly rely on all those things, you're going to miss a lot of great ones, because by the time that all that stuff is manifested in front of you, you can't get access to it.
I'll apologize for the baseball metaphor. I can't help myself. I remember when I was working at my first asset management job, Major League Baseball was one of our clients, the players. And we were specifically directed by the consultant not to use any baseball metaphors or analogies because the guys had had enough of it over their careers. So I'll apologize. But I didn't ask you to pack your crystal ball, but if you could put yourself back in center field and you're looking at the global economy and you've got to anticipate the direction of maybe the next hit. Where do you anticipate the direction of the global economy going when you just think kind of big picture as it relates to your clients' portfolios? What are some of those things? And I hate asking people what keeps you up at night, but what do you expect, that could be a risk that you want to make sure that you're anticipating when you are sitting in that position?
Yeah. These thoughts and views are my own, not necessarily the firm's, but, looking at the landscape, we have an environment that is very, very different, from a political standpoint. And that's either positive or negative, but it's opened the door to a new framework that we've never been at before. The debt levels of the U.S. economy are, astronomical, beyond what we've ever imagined. The U.S. dollar has weakened. We've had some tariff initiatives. So the landscape now is, and we've had some pushback globally to globalization. So the dynamic is very, very different than we ever envisioned before. And that is a framework that many of us, particularly of my age, well, all of us, but many of us, we never studied it. We've never experienced it. And it's creating a situation whereby some of the keys that we have learned, diversification matters and having differentiated returns matter. So that's what we're focusing in on and relying upon. Again, looking at these different elements that we incorporate within our client portfolios, the growth component, the diversification component, the inflation protection component is at the paramount of importance right now, because we're in more of an environment of uncertainty than we've ever been in some time. I think once that fleshes out, we'll get a better direction of whether or not, we want to tilt or be tactical one way or the other. But I think the good thing is that, with all the time that has gone by and all the work that has been done in terms of the Federal Reserve and other centralized banks, I think, and I do have high conviction that we have levers available to, shorten or ease the pain that we may suffer in any area.
Thank you for sharing that. These are the episodes that I regret restricting this to an hour long. We could go on all morning, so thank you so much. One last question. I am in the classroom in a couple of weeks of the fall at Drexel. Any advice to recent, or I should say soon-to-be graduates coming into this market environment based on some of those thoughts? What type of advice would you be sharing with a newly minted graduate from university?
I can't speak to what they're striving to do, but whatever you're striving to do, just continue to pursue it. Things don't necessarily work in a straight line. And if you're very, very passionate about something from a theoretical or personal standpoint, try to, even if you can't work in that space, meet people, network, learn more about it, and find inroads in those areas. And then, you'll find an opportunity to hopefully get to where you're going to go. The other thing, which is a little different, and I think we're all still trying to figure this out, is that we still have a group of students that have gone through the pandemic, whether it be, middle school, high school, or college, and, open up communication. I think, the devices that we have now, whether they be for our cell phones or our computers or things of that nature, kind of take away the natural engagement that many of us that are a little bit more seasoned have experienced. And that's truly, as I mentioned before, giving of yourself, speaking of yourself, learning of others, interacting, communication. That's truly going to be the foundation that's going to move you forward ultimately to where you want to go, versus just using a text or just using a LinkedIn chat. You actually have to engage. We actually had a very, very interesting situation with some of our associates. We told them to call someone, and they were like, "How do you do that?" And they picked up their cell phone. And it's like, well, there's a black box with numbers on your phone, and we had to actually give them a little bit of training on how to use a phone and engage. And that's humorous to a certain degree, but I think we've kind of lost sight of just the basic, interaction skills, and that's really what's going to move them forward.
I agree. And it's funny you said that. I put in a landline again for my daughters. My daughters are 8 and 5. So I gave them the phone numbers of their grandparents, their uncle, and then their cousin. So that's who they can call. So they can call anytime. The landline's there, and it's in the living room, just kind of the way it was for us. It was in the kitchen, hanging on the wall. So that's wonderful advice. Matthew, thank you so much for being here today. Thank you for coming to Philadelphia, joining us at Dakota Studios. We wish you nothing but continued success. Congratulations on the success you've had so far, and we hope to hear more from you.
Thank you so much. It's been a pleasure being here.
Oh, thank you. And Andrew, thank you always for being here.
Yes, of course. Real treat.
It was. Thank you. To our listeners, if you'd like to learn more about Matthew and Disciplina, please check out their website at disciplina.com. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We're also available on YouTube if you prefer to watch while you listen. Finally, if you'd like to catch up on past episodes, please check out our website at dakota.com. Matthew, thank you again for being here. Andrew, thank you as well. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye. back.